if your side hustle becomes your main hustle and actually creates a lot of opportunity for you, that's a good thing financially, but it can create some tax challenges. What are some of the strategies to manage that new kind of source of self-employment income so that you can help mitigate the taxes? We've got that and more coming up. If you leave your office job and you go self-employed, and then what if you have a lot of success with that? That creates great opportunities for your finances, but great challenges when it comes to taxes and other areas of your financial life. We're going to get into that story right now. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners here at Korhorn Financial Group, and back in the Wise Money Studio, certified financial planner, colleague of mine, Zach Broadwick. Welcome back in the studio, Zach.
It's great to be back.
All right. So Zach was on our Wise Money Spotlight just a couple of weeks ago talking about the dangerous long-term care risk. And what is that risk? Why is it such an enormous threat to your retirement and retirement confidence? And how do you manage through that? How do you manage that risk? If you didn't check out that episode, make sure you do so. But today we're going to get into a different topic, Zach, that you're just helping a client navigate, and that is going out on their own, going self-employed, and really seeing a lot of success, which we don't want too much of that success to go to Uncle Sam. So we're going to talk through that here in just a second. But I'm going to put you on the hot seat for just a quick second. We'll do a left turn here. You help a lot of people navigate through from their working years into successful retirement. What would you say is one of the most common mistakes people make in the first year of retirement?
One common mistake I see is people under or overestimating what they need to spend during retirement. Obviously, if you underestimate what you're going to spend during retirement, you could set yourself up for failure in the long run. And we see that quite often, actually. Is like people want to go out and have more vacations.
It's the go-go years.
Yeah. And that's why it's so important to work with a certified financial planner and get your spending figured out. So when you transition to retirement, there's not a gap in what you need to spend. You don't want to do less than what you had. But the opposite's also true. If you're overestimating what you're spending and you don't actually end up needing to spend that kind of money, you could have missed out on a couple of years of retirement.
Yeah. So spending's so emotional. And so our, Zach and our CFPs, we don't make any value judgments. You spend what you spend. Have fun. I don't care whether you like going out to eat at a Mexican restaurant or going to Taco Bell. It doesn't matter. But I think the point that Zach's saying, I completely agree, is have clarity over that. Have clarity. If you assume that you're going to spend one thing and you actually are going to spend less, you might be drawing more money out of your IRA, right? And paying more tax than what you really need to. And like you said, you could have also maybe retired a few years earlier. But if you assume you're going to spend one thing and you actually spend a lot more, not only does that create a short-term challenge, it creates a long-term challenge. You could overspend your portfolio and go from a confident retirement to not so confident. I completely agree. Work with your CFP. Make sure you've got clear assumptions built in. Retirement spending is one of the 5 factors. So, all right, Zach, let's now take that turn back. You work with a lot of clients, about 100 or so folks in a financial planning relationship, looking at all 6 areas of their financial life. Share a recent client experience with us and some of the strategies you use to navigate it.
Yeah. So just backing it up a couple of years ago, I had a client who historically was in a office job, pretty happy with it. Just got to the point where he wasn't feeling really fulfilled in his work and decided to go out on his own and become a real estate agent, actually.
Okay.
And if you understand or if worked with real estate agents in the past, they are paid fully by 1099. So they're contractors.
Yep.
Right. Which means when it comes to taxes, you're paying federal, state, if your state taxes income, and you're paying a self-employment tax on top of that, which is both sides of FICA tax.
So self-employment tax, 15.3% up to a certain level, and that 15.3% sounds punitive, but it's really both sides of FICA. FICA is 7.65%. You see that coming out of your paycheck. Your employer also pays that, though. They match it. You don't see it, but they match it. When you're self-employed, you got to pay both sides.
Mm-hmm.
Yeah. Painful.
Very painful.
Yeah.
So there becomes a point where you start wondering, okay, is there a better way to do this? Is there a better way to file my taxes as a now self-employed person? So we started going down a couple different routes. Obviously, he was started as what we call a sole proprietor, which just means on your taxes you're filing as a Schedule C on your individual tax return. So there's not an additional return we need to file to get that taken care of. There are other options out there. There's C corps, there's S corps, there's partnerships, and they all have actually a different tax return. And where we settled was we decided we were going to set up an S corp for this client, just because his income was getting to the point where it was beyond a reasonable salary. And I'm going to get back to that here in a second. So the way the IRS wants you to set up an S corp, especially if you're a sole proprietor, is you first need to pay yourself what's considered a fair and reasonable wage.
Yeah.
And if you're not to that point yet as a sole proprietor, we wouldn't want to set up the S corp because we wouldn't be able to meet that criteria.
Yeah, two mistakes we see a lot of people make when it comes to this same circumstance is, okay, I'm going to do the S corp, but I'm not going to pay myself a wage. That's a no-no. That's a no-no. And so you have to pay yourself a fair and reasonable compensation. But the other mistake that we see people make is they hear the benefits that Zach's about to share, and they say, oh, even for a little bit of income, I'm going to go and do that without enough resources or profit or income there to pay themselves a reasonable wage and to overcome the costs and the complexities of the S corp. So two big mistakes there I just thought I'd tuck in.
Yeah. So the big tax savings is after you have that fair and reasonable wage, you're paying that. You're obviously paying federal. You're paying if your state taxes, and you're paying both sides of FICA, that 15.3 that you alluded to. Everything else on the S corp is considered profit to you and comes through as just as capital income essentially. So it's only being taxed on the federal and state side.
Yeah.
So
no self-employment tax
on that. No
FICA on that.
Yep.
Yeah.
Correct. So you can think say for example, you paid yourself $50,000 and you made $150,000. You're essentially saving $15,000 a year by making this election. So again, talk to your certified financial planner. That would also be or your tax planner, as to what would be considered a fair and reasonable wage for your industry before you make some type of election like this. But in his case, for this particular client, we made the election earlier this year, and he's having his best year ever by far.
Yeah.
So it's a huge tax savings for him. It's a lot of money left in their pocket where they can explore other goals that they have. And with this particular client, they're very into real estate, obviously. And so one of their goals is, I want to be able to have more rental properties and build that portfolio. And $15,000, even if that's what the savings is every year, you can build up for a rental property fairly quickly if you're diligent.
So going to an S corp, instead of being sole proprietor, that's going to increase the complexity. You've got to file an additional tax return, okay? So no longer just on your own individual return. You've got to file quarterly withholdings with the IRS, 941s. Those are, you have to pay yourself a salary, fair and reasonable wage. You then have to report that salary and your withholdings on a quarterly basis. Those are 941s. You then need to file for unemployment even, and workman's comp. You might have to do that as well. So there's other tag-along sort of complexities. So this is not, if you're hearing that, oh gosh, if I become an S corp, I can save self-employment tax, therefore I'm just going to do this. No, it's going to create a lot of complexity. You have to have enough income so that it justifies those new costs, that new complexity, and then be aware that the profits that flow through, and you only pay Fed and state tax, you're not paying self-employment tax. Therefore, those profits are not being calculated in your Social Security and your calculation for your future Social Security. A lot of times people say, worth it, I'm fine, but you want to be aware of that. You need to consider that.
Yeah. And a couple other considerations. One is from a cash standpoint in your business, you need to make sure there's enough cash in there to float you, especially when you're in a volatile industry that you might see $20,000 worth of income one month and $5,000 the next, you need to make sure that there is a healthy cash reserve there. If you decide to hire someone on, you would add them to your payroll. You would pay your half of the self-employed FICA taxes for them. But then you would also need to make sure, okay, I need to make sure my employees paid as well.
Right.
So there's a lot of additional planning considerations for the business itself before we even get back to the personal.
Okay, so let's go back to the personal then, because this also opens the door for setting up your own retirement plan. So go ahead and share that, Zach.
Yeah. So one of the great things about being a self-employed individual, again, this applies only if you're the sole proprietor. You're the only person working for yourself. Is what we call a single K. So essentially, it's a 401k, but it's just for yourself. Yep. Some people call it a solo K. There's other names. I like single K personally. So the great part about that is you can put, under today's rules, $23,500 of your wage that you're paying yourself into a solo 401k or a single K. But that number can go up even higher when we start talking about profit sharing as well. And I think the recent number was $70,000 if you're under the age of 50 that you can get in there if you meet certain criteria, if your income is high enough to justify that.
And those numbers are going up next year. The 401k contribution is increasing by $1,000. You can do this would just be like any other 401k for the most part, where you've got catch-up contributions that you can do. And like Zach said, it's a profit share. And well, guess what? You are the business, so you can elect to make that profit share contribution up to a certain percentage of your wages, 25%. You can get up near that maximum amount and shelter a lot of money from Uncle Sam that you've earned in profits. So fantastic strategy. So whether you are someone that is considering venturing out on your own, doesn't need to be a realtor, but could be, handyman service, could be whatever your side hustle is or whatever your giftings are. If you're thinking about, leaving that normal corporate job and going out on your own, you want to be aware of this. And if that going out on your own becomes your main deal and your income surges, like in the story Zach shared, you want to work with your certified financial planner to explore those entities. What's the right fit for you from a liability protection standpoint, but also what are the tax ramifications? What are the cash flow ramifications? What are the retirement ramifications as well? Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on our team. You can find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.